Hey guys, it's Crossroads here. Today, I wanted to give you an update on my portfolio, specifically some major changes that have happened and a huge mistake that I made that might cost me over the long term. There's also a new number one holding in my portfolio, which I know will surprise a lot of folks, frankly, myself included. So let's go ahead and take a look. This right here is the heat map. So you can think of this in terms of how the stock market heat map looks like as far as the S&P 500. And not so much heat maps, but you can see the percents there for stocks. I also have this other category right here. So this is included in the overall percent. These are investments of a different category and type as well. So when you're looking at 22.8%, it's not 22.8% of all my stocks, but it's including this other. One thing that's not included, by the way, I do have maybe about 20% of my assets. They're just in broad-based ETFs that are in a separate account that I don't even bother looking at these days. I know that it's there. That's allowed me to be more aggressive. In the past, I used to be 50% of my holdings, but I keep outperforming, and that's a nice problem to have. So what's in the other? Well, 12.8% cash. Now, this is not cash that's in my bank account. This is cash that's ready to be deployed in the market and in crypto. Why is that so high? Well, I got out of some swings. Of course, I talked about Webull, and I was excited about that opportunity. Ended up with the way that they were doing that offering. I said, you know what? I don't know that I trust the management. I'm going to get out. Basically, it broke even. If I had waited just a week, it would have been great. But I didn't do that. Sometimes that happens. So cash is up a good bit as I've consolidated some of the swing positions. And also, I made a massive mistake with one of my holdings. And as a result, I have a lot more cash than I would like to have. Usually at most, I like to have about 10%. When I see an opportunity, as far as like there's nothing on sale in the market, I'll start holding cash and hoarding cash. Or if I see that there's some risk of a local pullback, I'll go up to maybe about 10% cash. So this is a little bit heavy actually from what I would want to do. Also had a invest and investigate position on eToro. I was looking at it for similar reasons as Webull, also a recent IPO. They're just not as strong of a company as Robinhood. In fact, if anything, my conviction in Robinhood became stronger after looking into these two companies. So I have 3.4% overall in a swing position. There's a couple of stocks in that. Lululemon is the largest. It's not been doing well. That's not a huge surprise, but it's a year to a year and a half swing position. 2.5% crypto specifically as well. So that's what's in the other. Crypto, of course, Bitcoin is most of that. I do have some Ethereum and a couple other little things as well, but it's almost all Ethereum and Bitcoin at this point. And my only DCA right now is Bitcoin. I've continued to allocate. I'm actually more than 1% of my income in Bitcoin, and I think I might just do that over the next 10 years. I don't see a reason not to. I like having that asset in my portfolio. So let's take a look, with that said, in stocks specifically. What are my holdings? Well, you can see here, my smallest holding is actually only 1% of this overall portfolio. And so what is that? Well, specifically, that is this company right here, Tesla. Now, you might say, well, wait a minute, Roy. Last year, at the beginning of the year, you said that you wanted to hold and get Tesla and just build that out. And I did. And it did quite well. Of course, Tesla at the time was trading in the mid hundreds, and a lot has changed since then. And so one of those things for me is the way that I regard Tesla. Specifically, Tesla has had some headwinds, some because of Elon Musk's close affiliation with Donald Trump. There's been a drag on that as well. Higher for longer has been painful. At the same time, a lot of subsidies for green energy have been or are in the process of being removed, which is a headwind for Tesla, especially on EV vehicle cells. Yes, they'll still be around. They're not going out of business. If they lose profitability at most, it'll be for a quarter or two. They have a fortress balance sheet. They're going to be perfectly fine. And I love the product. We just bought our second Tesla. It was our first new Tesla, Model Y. We love it, love the ecosystem. Can't wait for the robots. Robotaxis will be a great thing. That said, Elon has limited the TAM somewhat. There is some lasting brand damage. It was overstated initially, but there are people that don't trust Elon. They don't trust Tesla. And as a result, they will not buy a Tesla, even though they acknowledge for many of them that it's a superior product. They will not get into robotaxi because they won't trust it. And they also will not have a robot from Tesla in their household. So, over the short term, there's, I think, a lot of headwinds, and there's an opportunity possibly to add lower, and I'd be happy to add. But for right now, I'm regarding this I know it's a little bit silly, but as a speculative biotech stock. That's how I regard it. Those sort of things, I don't mind holding at a 1% allocation, which is where I have Tesla at. Now, if the stock price falls more, or if there's some changes in what's happening with Tesla, some which they cannot control and some which they do, then I certainly will look to add. It's still an incredible company that, I mean, it's going to do so well as a company, but the stock is not cheap where it's at. I don't know that it'll ever be cheap, but I'm not going to add here. I'll just wait and hold what I have, not looking to sell, not looking to buy, just watching. So that is my smallest position. What is my second smallest position? Well, that is actually NVIDIA. And no, don't think that these are all in order. We are actually going to do them out of order. NVIDIA is about 4.5% on my portfolio overall. It's one that is one of my newer holdings. Now, NVIDIA at the time, Tanner had actually pounded the table on this, and he said, hey, NVIDIA, you got to buy it, guys. And so Amit and I argued, discussed, debated with him, and ultimately, as the stock price continued to fall, we're like, yeah, Jensen Huang is an amazing CEO. This is one of the strongest, best companies in the entire world. And they're so well positioned over the next 5 to 10 years and probably beyond that, although it's further out you go, the harder it is to see what the world will be like in 10 years even. But unless you just don't believe in AI right now, NVIDIA is going to have a huge part of this. Now, NVIDIA is only, it's still less than 5% of my portfolio. I wouldn't mind getting it to 10%, partly through price action, but also through allocation as well. But when NVIDIA fell, I said, you know what, I'm just going to DCA. I don't know how long this is going to last. I don't know how low it's going to go. I'll just buy so much amount each week, and I'll just let it work out. And of course, it's now at an all-time high. So it's a first $4 trillion company. I don't think it's expensive. I'm not DCing right now, but I don't hate the price here. I actually think it's still pretty attractive, and likely because of the large amount of cash in my portfolio, unless something else happens during earnings season, and it might, a lot of that's probably going to go into NVIDIA, even at all-time highs, which I know is silly. I know it's strange, but I think over the long term, they're going to do well. Are they going to be the best performer? No, but they bring it's just an easy outperformer over the next 5 to 10 years for myself over the index. And I don't mind having something like that just to anchor my holdings and make it a little bit less volatile. So what is my number 2 holding? So my number 2 holding itself, we're going to go out of order a bit here, is at 19% overall. And 19% overall is PayPal. And you might say, well, Roy, I thought that you wouldn't go over 10% unless you thought it was just an absolute unicorn of a business. That's right. And I've broken my own rules. Now, part of that, though, is I do have about 10% of my portfolio in shares for PayPal itself. And the other, that's almost 9%, are leaps. Now, some of those leaps are actually up. Some of them are down. And it's been a painful hold overall, but nevertheless, I've basically made it pretty conservative with the leaps as far as time as I could go at $90 strike, which I don't think is ridiculous. In fact, I still think that PayPal will see an all-time high by 2030. My plan with the position is it's overweight. I don't need to add any more here. In fact, I don't want to. PayPal itself, I think at worst is going to be an opportunity cost. I do think that over the next 3 quarters, the market's likely to realize what they're building and begin to appreciate in terms of value. But it may not be until Q4, which is in January of next year. Q2, it's got some Braintree headwinds that are slowing down that overall revenue growth, which I think right now the market is pricing. But I think that they'll do very well in guidance. I think that it'll be another triple beat. Alex Chris guides very conservatively. What they're building is not really being disrupted nearly as much as the market expects. It's not that everything is good and golden. I actually have a recent post on why to not buy PayPal right now, even though I'm doing the opposite with both hands. But that's where I'm at with PayPal. I don't want to add here just because I'm like, hey, it's already 20% of my portfolio. PayPal will not go to zero, but like hypothetically, if it did, 20% is a bigger hit than I would be happy taking. So that's where I'm at here. Those shares I plan to have for a long time, as long as they execute. Now, if we get to Q4 or Q1 next year, and I'm like, hey, they are floundering, they've lost their vision, all these things that they said that they're doing, they're not executing on, they're not building on. At that point, I would begin to reduce that position. I'll let you guys know if and when that happens. But overall, except for just a couple of things, I'm pretty pleased with what they've been doing as a company, even though the stock price action has been absolutely terrible and miserable. So, with that said, let's look at the third smallest position right here, and that would be Nubank. So, Nubank is one that is just a little bit over 5% of the position. Actually, no, I'm mistaken. Nubank is slightly bigger than the other position that we're going to look at here. Nubank is 5.7%. So it's actually about in the middle of my portfolio. 5% is a good amount for me. There is one that's a little bit smaller there. But why is Nubank at 5.7%? Well, a lot of it is if you look at what happened on Friday, Nubank got slammed and hit by geopolitical stuff. That's one of the risks of Nubank. It's an incredible company. It's going to be around. It's going to dominate for a long, long time. But there are oftentimes geopolitical headwinds, even though they're positioned in Latin America. Most of that's in Brazil. And just Google it. Google, look at the news. There's weird things with Lula, with judges, visa stuff in the United States. It's just, it could get worse. There could be a civil war, which would be terrible. Not laughing about that lightly, but honestly, I think that that's very unlikely. Brazil has always had these sort of moments. They've had recession stuff, and the real has not done well against the United States dollar, which just crushed it in quarter one, made the revenue just because the dollar was so strong in a very difficult place. Now, there's also some short-term headwinds for about a year or so in Mexico as they actually roll out depositories. So there's a cost to that, but long-term, it really helps them on the margin side. So they're doing well with Mexico. They're doing well in Colombia. Argentina looks like maybe the next destination as well. And the United States wouldn't surprise me. Their TAM is immense. They grow well. They know what they're doing. And so this and PayPal and also SoFi are the only companies that actually have leaps on. Everything else is shares. And here I have, I think, as much in terms of shares as I do leaps. Kind of like with PayPal, it's been a painful hold, but not as painful as PayPal. So what then is going to be my third largest position? Third largest position is 14.4%. And that's one that has run a lot. It's one that I was happy to allocate about 10%. And it's outperformed, frankly, and that is SoFi. SoFi is on an immense tear, and I actually don't think it's a terrible valuation here. If I hadn't already had SoFi as that large in my portfolio, then perhaps I would actually even be adding at any pullback. I think long-term, they're positioned very well, but in the short term, over the next year and a half, there are so many ridiculous tailwinds and headwinds that have shifted to tailwind for SoFi. Regulation has been against them. They had to deprecate their crypto platform. Student loans were on freeze. That was their main business. Interest rates were very high. Macroeconomic uncertainty, you name it, they faced it. And yet they not only survived, but they became profitable. They're growing at over 30% year over year. This quarter, because they report against a very weak quarter, they're going to look like they're growing even faster than they are. And the loan platform business, it's ridiculous. It's a ridiculous upside with very, very little negative impact on SoFi, simply because they can lend without capital constraints, or basically referring those loans. That fuels so much in their business. It really does. It's one of those that it just was a no-brainer play. I don't know why it took the market so long, but the market realizes what SoFi is. And it wouldn't surprise me, even not adding anything. I don't plan to sell anything in either short term, over the next 6 months. I'm just not. If we see SoFi actually go into the number one position, just based on PayPal maybe being a little bit of a laggard and SoFi having immense tailwinds, and we'll also talk about soon what is number one. In fact, let's do the second smallest position, or rather third smallest position here. It's one that's just slightly larger than NVIDIA, and a lot of that is just because it has run a lot, and that is Hims and Hers. Hims and Hers is one that I started getting into late last year. I bought around 17. My average is under 25. I've actually taken some off the table. Hims, I was happy to have up to a 10% ratio, and you can see it's about half of that. Now, the reason is twofold. One is I still think that there's some lawsuit risk as it relates to Novo Nordisk, although I think part of that has diminished. Look at the Washington Post article that featured the CEO of Hims and the background as far as that partnership breaking up. But I also think this is a pretty challenging quarter for the company. They did note and report that they will have their first sequential decline as those shortage list GLP-1 revenues begin to roll off. But it's kind of a no-win quarter in my mind. They guided very aggressively for the year, still knowing that the shortage list was ending. And so if they end up beating and crushing that in quarter two and they don't decline, lawsuit is probably going to happen just because they've done that on the back of the 503A pharmacy exception, which is being used perhaps more than its intended purpose. And so that'd be a legal challenge. I wouldn't love that as an investor, but I still want exposure to HIMS. I'm actually, some of that cash that I have are in cash secured puts for HIMS. Even at higher levels, I'm like, hey, I wouldn't mind adding a little bit more here. And of course, if HIMS is hit by a lawsuit, that's not the end of the company. That's not the end of the story. That's an opportunity to buy with both hands. And so I will do that. I'm ready to do that. I won't mess around with DCAing. I'll just be buying at certain levels quite a bit. Actually, I might even go up above 10% with some of the swings that I put in the position. But yeah, short term, there are some challenging headwinds. But I mean, the company is doing very well. They're positioned very well. I love what they just did with the flywheel. Look at my video on that recently as well. So we just have a couple of stocks and tickers left. Now, you guys know that Palantir was my number one holding at one point back in 2022. It was 90% of a much smaller portfolio at the time. Of course, Palantir did really, really well since its colossal run from the single digits. My average in this company is not factoring in what I get from the covered calls premiums. It's like 12 and change. So I've done okay on Palantir. Now, my mistake was with Palantir. So Palantir is now 8% of my portfolio. You might say, well, wait, Roy, are you bearish on this company? No. I mean, like, look behind me. I've got right over my head a pickleball that's Palantir. I love this company. They say not to fall in love with your investments. Well, I've fallen in love with this company. I really like and admire what they do, the employees that I've interacted with. I think that they're positioned just so well. They have one of the strongest moats out there. They're still growing immensely. I think that might continue to accelerate. It wouldn't shock me if we even see some 50% year-over-year growth. They are expensive. And so one of the things I didn't mind doing is taking some gains from Palantir and making a sell. I posted a video on that as well. Of course, it was a lower level because Palantir keeps hitting all-time highs. But I took some of that off the table just to keep our debt level the same as we bought that new Tesla. That was important to me. And since we might be moving here in the next year or so, a little bit closer to where I work here in Houston. Now, the big mistake, though, was not taking gains. The big mistake was underwater covered calls. And I had a large amount of my Palantir position underwater. They were stuck at $70 a share for covered calls. These are ones that I sold. I thought I was being conservative, and I was not nearly conservative enough. Things ran. Now, I did get some back as we fell during April, but I figured like, hey, I might have another couple of weeks of this to redeem and buy back most, if not all, of these shares, and I didn't have that time. So as a result, the stock price kept running, and I continued to roll it out gradually, and I'd roll it out for a few weeks, or I'd roll it out for a month, or I'd roll it out to the next quarter, oftentimes even using a little bit of money as well to do it at a higher strike. But the deeper it was underwater, the harder and more challenging it was to be able to roll those out. And at one point, it stopped kind of making sense. But I said, you know what? I don't want to lose my shares. And so I just kept at it. And then I lost my shares. So that can happen in one of two ways. One is that somebody can do an early exercise. Now, they can say, I don't want to wait for the expiration date. I want to have these shares now. Now, that's very rare. A little bit more common on dividend stocks, but Palantir is not, despite what shareholders keep asking on earnings. But I lost track of when the expiration was. It was a weird market. It was one of those weeks, well, you can look 4th of July weekend, that the timing was just off. I thought I had more time to roll those. I lost sight of what I was doing in the holiday weekend. And so they got away. And I was so frustrated and mad at myself. That said, I didn't just go right behind and buy back in. Now, this is all my Palantir is in a non-tax advantaged account. The good thing is they were all short-term, or not short-term, long-term capital gains. And so it's not going to be nearly as painful as it would be if they were short-term. But I need to be careful with how I realize gains for this year, just because I realized a lot more than I expected. The rest of my position, I'm being very careful and cautious with. I would love to add back to Palantir, even at a level higher than $70. but we may not ever see it again. We'll just have to see. So obviously, process of elimination, that leaves one position remaining for number one at 22.8%. And that is Robinhood. And you might say, well, Roy, why is Robinhood your number one position? First, I think it's a generational company like Palantir. It's the same quality. It's a unicorn. Frankly, what they rolled out in France for their gold event, or their crypto event rather, private equity, tokenizing U.S. assets. Those are all good. Those are nice things. What got me really interested and excited, and it finally clicked as far as this being a generational company, is what they mentioned as far as a Robinhood chain. And that's just a mention. You know, if most companies did that sort of thing where they're like, hey, we're moving our entire company on chain, be like, sure you are. Doesn't really mean anything. It's stupid. It's just for optics. Not for Robinhood. This company does not mess around. What they're building long term, I think, puts them as one of the largest financial institutions in the world in 5 or 10 years. Now, market cap, they are moving up, but I'm seeing these guys in parallel, although differentiated, and it will look different and it will still be a lot more cyclical. But in 10 years' time, it could be rivaling where Visa is right now as far as its rankings overall. Now, Visa will continue to grow and be bigger than Robinhood in 10 years. I'm not saying that, but they are massive. When they say democratize finance, they mean it. They don't have any silos. Vlad isn't stopping anytime soon. And there's so many tailwinds globally. If you look at, they keep unlocking more and more of their TAM. Are there risks? Well, sure. Like it's trading at an all-time high. It's trading at a pretty extreme premium right now. Not too extreme, but it's not cheap. I personally am not buying here. I would be glad to, though, add to this company if it pulls back pretty aggressively, and it might at some point. It's still cyclical. A lot of its revenue does come from crypto, just because this is one that I want in my portfolio for, the next decade. Even though it's cyclical, even though not everything is perfect with any of these holdings, but that is where I'm at overall. And it's a very different look than where I was before. And frankly, some of these are not where I would like to have them. We'll have to see how that develops over the short term. I do, again, have way too much cash, but that's not a terrible problem to have. I will be deploying that over through earnings season. I'll be selling cash ticker puts too, and some of those names that have earnings. Maybe some of them will get hit. And usually in earnings season, there is at least a couple of companies that are incredible, amazing companies that get sold off irrationally. And some of those are on my radar that I'm looking at that I'd love to start a new position in, or even some that I exited, like Enphase and Accelera, which I'm like, hey, I would love to get back into these too. I just wanted to concentrate more on PayPal, which in hindsight, short term, it was a mistake. Long term, we'll have to see. So let me know what you think in the comments. You can call me an idiot for selling Palantir. That's fine. I don't mind that. I got thick skin. One of the nice things about being a retail investor is you don't have to report to anybody. I just do this to show you guys like, hey, I am human. I make a lot of mistakes. I do get things right from time to time as well. So if you have messed up like I did just a few weeks ago, don't feel too bad. It happens to everybody. And honestly, it's one of those mistakes just because of the valuation that might end up working out pretty well. Because what would have happened possibly otherwise is that part of my portfolio, which was pretty large, would just not have any gains for however long it took to roll those out, which could have been a long time. So probably, maybe not as big of a mistake as I thought, but it still frustrates me. Anyway, there you have it. Thank you guys for watching, commenting, and subscribing. And until next time, happy investing.